Live from Bloomberg's world headquarters in New York, I'm Scarlett Fu.
And I'm Tim Stenivek. Welcome to Bloomberg Crypto. It's a look at the people, transactions, and technology shaping the world of decentralized finance.
Here's what's at stake today. The Clarity Act was on the 1 yard line as recently as last week. We get the latest out of D.C. and talk to a top executive at Coinbase.
Plus, we hear the banker perspective on Clarity Act. We're going to talk to Rebeca Romero, Rainey, president and CEO of the Independent Community Bankers of America.
And Fanatics makes a move to improve its position in prediction markets.
All that and more over the next hour right here on Bloomberg Crypto. First, though, we got to check in on the price action and see how things stand. It hasn't really that pretty. Bitcoin been trading in the low $60,000 range, going all the way back to that big drop in late May. You can see it right there at the beginning of June, all the way until now, almost the end of July, down about 10.5%. The token, though, sliding this week. It's ahead of the Fed decision tomorrow. Citadel, get this, says that the FOMC may actually hike rates. That would be to shore up price stability and confidence in the Federal Reserve. It would overshadow recent momentum in risk assets, Scar.
All right, while Bitcoin and the rest of crypto have really yet to recover from their October sell-off, President Trump has done better than good with his crypto investments. He reported at least $1.4 billion in crypto-related income last year. That is more than what any publicly traded U.S. digital asset company earned. Coinbase, which is the most profitable U.S.-listed crypto platform, that company reported $1.25 billion in net income last year. Now, as for what Trump earned, he generated about $594 million from World Liberty Financial, about $636 million tied to his meme coin business, and almost $200 million from an equity sale that was tied to Stablecoin Holdco. Most of that income, by the way, is from one-time token and equity sales rather than recurring operating earnings. All of this is according to a financial disclosure released by the U.S. Office of Government Ethics.
Okay, so that is the lay of the land, at least when it comes to the president and this bill. That all brings us to political exchange. The president's big crypto windfall has become the biggest obstacle to passing the Clarity Act, with Democrats and consumer watchdog groups complaining the bill would not stop President Trump or his family from continuing to profit from crypto ventures. Bloomberg's Stephen Dennis has been covering that story. He joins us live from Capitol Hill. Stephen, if that's the obstacle, then how do lawmakers get around it?
Yeah, it's been a big issue now for a year because the Democrats want to put in place guardrails that prevent the president from continuing to make literally billions of dollars from an industry that he regulates, and the president doesn't want anything that would cost him money. So how you sort of thread the needle there is what they're discussing behind closed doors. Tom Tillis, Republican of North Carolina, is working with Ruben Gallego of Arizona, the Democrat. They are trying to come up with some kind of compromise legislation to send to the White House this week in hopes of unlocking a deal. There are 7 to 10 Democrats who sound like they want to ultimately pass a bill, but this is just very hard for them politically. Even if they like the underlying bill, they're going to face challenges in Democratic primaries from their own base saying, hey, you just backed legislation that the president that they don't like wants at a time when he's making literally billions of dollars. Now, I think one of the things that they've been discussing is whether there could be a more independent way to enforce the new restrictions on the president,
right,
which would require him to either have a blind trust or just divest his holdings. But it's really hard to see how you can get the president on board with that.
So, Stephen, there is a provision that would sunset the ethics requirement on January 20th, 2029, and that would be the day that President Trump's successor would be inaugurated. What does that kind of sunset provision mean for the outgoing Trump administration and the incoming whoever administration?
Yeah, so I mean, that's great if you're Trump. It means basically you don't have to have any accountability from a future administration. Say he, for the sake of argument here, which the Democrats are pointing out, is he could do whatever he wants in those final days, final weeks, and nobody would have the ability to really enforce it against him because once Inauguration Day happens, the slate's wiped clean. You can't go back after the fact.
Right.
And so that's something that Democrats don't like. They also want to have state attorneys general to have the option of going in as well. And there's so many other issues with this bill that are getting discussed right now, and banks are making a big, hard push on stablecoin interest. John Thune told reporters yesterday that that's something that they're looking at, and there could be a robust amendment process.
Sure.
So if this ever gets to the floor, we could see the banks versus crypto in a really big floor amendment fight as well.
All right, Stephen, thank you so much. Stephen Dennis joining us live in Washington, kind of setting up the discussion here. In the middle of this critical time for crypto policy, there have been executive shakeups at Coinbase. You have longtime Chief Legal Officer Paul Grell leaving the company. He was also a frequent guest here on Bloomberg Crypto.
Meanwhile, Coinbase has named a new vice chair, Ryan VanGrack. Ryan previously served as general counsel for Citadel Securities. He also worked as a White House deputy associate counsel in the Obama administration, and we're pleased to say that Ryan VanGrack joins us now. Ryan, congratulations on the new role. We're going to get to the sort of goings on over at Coinbase in just a minute, but I want to pick up where we just left off with Stephen Dennis, who covers Congress for us. And I'm wondering how you guys at Coinbase are thinking about this bill becoming law when these obstacles remain.
Absolutely. Well, it's great to be with you here today discussing this very timely and important issue. I start from the fundamental premise with legislation in that you cannot have the perfect be the enemy of the good, particularly when enhanced consumer protections and law enforcement tools are at stake. No one in DC gets everything that they want. That's why it's a negotiation and it's not a capitulation. Here, you have to baseline this bill against the status quo and ask yourself, will consumers be better off? And there is no longer a reasonable debate on that question. It is a resounding yes. And we know that because there is a growing consensus of groups that support this bill.
So
we have
yeah, go ahead.
Let me spike. You got law enforcement groups like the Fraternal Order of Police supporting it. You have most major asset managers like Goldman Sachs and Schwab and BlackRock supporting it. And you have millions of crypto customers themselves supporting this bill because it provides these enhanced consumer protections.
Some Democrats, consumer watchdog groups, as we just heard from Stephen Dennis, say that they complain the bill would not stop the president or his family from continuing to profit from his meme coin and other crypto ventures. Are you guys fine with that?
So the ethics provisions that you're referencing are something that the industry has not been involved in. Those discussions and details have been hammered out between members of the Senate and the administration. And as Stephen himself just noted, it's our understanding that Senate Democrats and Republicans continue to work together to try to resolve those issues. And we are in support of efforts that will allow this consumer protection bill to ultimately advance.
Okay, so that's kind of the take for you, Juan, on ethics. The industry, at least, kind of has to step back. From where you sit, ethics aside, what is the single biggest obstacle to the Senate passing the Clarity Act?
Well, the truth is the obstacles continue to shrink. One of the benefits of some of the timing pressures that I know have been covered is with respect to the Clarity Act is it allows parties to sharpen their focus and prioritize what really matters. And you don't have the same cacophony of issues that are being raised in terms of the substance of this bill. And that's because ultimately, again, law enforcement, retail investors, asset managers realize that compared to the status quo, this is going to introduce a comprehensive set of rules and regulations that do not currently exist. And it's important to keep in mind. Yes.
Let me just ask you, Scott Bessent had said last week that we're on the 1 yard line when it comes to passage of the Clarity Act. What yard line are we on right now?
We're either on the 1 yard line or maybe it's the half a yard mark, which I know still in football is technically the 1 yard line. And that's because you still have Democrats and Republicans working together to get this bill across the finish line. The number of issues, the voices expressing concern about this bill continues to actually quiet down because so many of the details have been worked out, and what remains is far narrower than the list of issues that existed even just a few months ago. So I think we remain very, very close to passage. You've identified some of the few remaining hurdles, but all of them appear surmountable. And as long as Democrats and Republicans are working together to get it across the finish line, I remain optimistic that we will do just that.
I told you we'd get to what's happening inside Coinbase, and that's where I want to go now, Ryan. We've seen several Coinbase executives leaving or changing jobs in recent weeks. I think from the outside to some, this may look like a lot of the leadership team that essentially fought the war when it comes to what's happening in Washington right now, maybe leaving at a time before a peace deal is signed or before the battle is won, if we want to continue with that metaphor. From your view, and I know you're relatively new, but what is going on at Coinbase?
Well, I think you hit the nail on the head. This is the next chapter for Coinbase. For so long, we were fighting that war on crypto, but we won. We defeated the SEC's case against us. And what you've seen in just even the last year and a half is a sea change in terms of how crypto innovates and how it interacts with its regulators. And so we recognize that now is the time to transition from defense to offense, from reactive to proactive. And so part of that involves, me stepping into the role of vice chairman and other leaders to continuing to step up so that we can kind of triple down on our efforts to innovate, to unlock and introduce new products to our customers, and to expand in other jurisdictions, all so that we can truly become the future of finance going forward.
Ryan, before you came to Coinbase, you were general counsel at Citadel Securities, which is one of the most sophisticated trading operations in the U.S. on the planet, really. Coinbase is now building equity tradings, prediction markets, perpetual futures, AI tools, all on top of that existing crypto exchange, which some might say sounds an awful lot like Citadel's playbook. Is the end game here for Coinbase, your new company, to become a full-range, fully integrated financial firm that ends up competing with the firm that you came from?
Well, our goal, as you identified, is becoming the everything exchange. We want to be a one-stop shop where you can trade stocks, commodity futures, crypto, perpetuals, you name it. We either have it or are going to want to try to build it. So we see the entire financial industry as both partners and potentially competitors, because at the end of the day, the future of finance is going to run on crypto rails, and Coinbase has been a leader in that regard. So we see an inevitable convergence between traditional finance and crypto, so that a couple of years from now, even your questions are not going to be identifying this dichotomy within the industry, but rather talking about how every modern financial institution is embracing the efficiencies and benefits that crypto provides.
Ryan, is there going to be a challenge in terms of branding and making sure that customers and potentially new customers understand that this vision for Coinbase is more than just crypto?
I don't think so. We've already launched many of these products, as you note, and at the end of the day, customers want convenience. They certainly want clarity, and they want regulation. One of the benefits this bill is going to provide is ensuring that there is this comprehensive structure between the SEC and the CFTC as it relates to crypto, but also as it relates to trading all of these other asset classes, both on crypto exchanges, but also within traditional finance. And so again, both traditional finance and crypto are involved in these conversations. And you see companies like Goldman Sachs, Schwab, Fidelity, all supporting this bill because they are embracing crypto. They are investing in crypto, and they are partnering with companies like Coinbase because they too recognize that crypto is a future of finance. And so it's really not a question of branding. It's a question of providing customers with a more efficient and thoughtful way to engage in the entire financial ecosystem.
Big thank you to Coinbase Vice Chairman Ryan VanGrack. Ryan, appreciate your time. Do come back soon.
Same here. Thanks for the time.
Well, coming up, concerns about the Clarity Act are coming to the surface as it makes its way through Congress. We continue the conversation with Rebeca Romero-Rainey of the Independent Community Bankers of America. She's going to highlight why. Also, to access all of the latest data and news on crypto, check out CRYP Go on the terminal. This is Bloomberg.
You heard the argument for the Clarity Act. Our next guest, Rebeca Romero-Rainey of the Independent Community Bankers of America, has a very different take. She says the Clarity Act is being fast-tracked through Congress to the benefit of high-spending crypto lobbyists rather than serve public demand or protect Main Street financial stability. ICBA President and CEO Rebeca Romero-Rainey joins us now. Rebeca, thank you so much for speaking with us. You heard what Ryan of Coinbase just said. What's your response to the crypto industry's perspective on Clarity Act being much closer than where we've been so far?
Well, I still think there's a lot of unresolved issues. And I think at the end of the day, when we are talking about what serves the American public the best, I would say it's community banks and the fact that we are aggregators of local deposits that make over 60% of small business loans and 80% of the agricultural loans. We're concerned that the legislation as it stands would lead to tremendous deposit flight out of communities into the hands of crypto industries and not back into small businesses, consumers, and we're asking why. There's still a lot to be resolved.
Well, then how would you, if you were able to actually write this bill with language that would be approved by the community bankers of America, how would you solve for the idea of deposit flight or the concern of deposit flight? What's the solution there?
So we've actually delivered to the Senate a series of what we're calling some language fixes. I mean, there's loopholes that as you go down one by one, basically what we're saying at the end of the day is if we're creating an infrastructure for payment stablecoins, let's limit to that. If we are trying to create an alternative to deposit accounts, the language and the rules should reflect that. And so as it relates to the specific fix, let's ensure that we're not leading to deposit flight and in creating alternative through the payment or allowing the payment of interest in yield on what may be aggregated balances in stablecoins.
Rebecca, I'm curious as to how united the banking industry, from small players like community banks to big players, in opposing yield-bearing stablecoins. Community banks argued that these yield-bearing stablecoins would drain the deposits that fund Main Street lending. The big banks talk a lot about regulatory arbitrage and shadow banking. So to what extent are these actually the same concerns, or are community banks fighting for their funding model while the biggest banks are fighting for competitive parity?
Well, I think there's a little bit of all of that going on. And certainly, as we start, I think the industry as a whole is saying if we're going to be doing the business of banking, let's apply the rules and the regulations of banking at the end of the day. For community banks, what we're saying, and studies have shown that if in fact the payment of interest and yield is allowed, it can lead up to $1.3 trillion in deposits leaving the community banking system and a loss of $850 billion in credit. And that's what I think we as the American public really need to focus in on. Who's going to fund these small businesses, the ranchers, the farmers, as these deposits leave the local community? So there's many impacts here that we really need to take into account.
Some might say this is the free market at work, though, and I know there's like legislation around this happening, but what would you say to somebody who says, okay, wait a second, community banks are paying 0.1% on checking accounts. Stablecoins offer 4 to 5% when it comes to yield. A small business owner in a rural community might look at that and say, well, they're failing to pay me a yield that I actually see as a good place to park my money. Why should Congress protect a business model that underpays its depositors?
Well, so as a third-generation community banker myself, what I would say is that community banks welcome competition, and depositors, consumers, small businesses have choices today. They're making a conscious choice to deposit in local community institutions, to redeploy their funds, their capital back into growth of their local economies. There is so much that local communities benefit from the presence and the strong engagement of a strong local bank. And again, it's about choice, but if we're going to do the business of banking, let's apply the same rules of the road. And let's ensure that those consumers are taken care of, that we have the same safeguards and a resilient system that is there for those consumers, not just in the good times, but in the challenging times as well.
Rebecca, you asked the OCC to pull Coinbase's National Trust Charter, and your organization launched a six-figure ad campaign against the Clarity Act. You told The Hill in an op-ed that the core question is really, why are we rushing this? But we know that this bill has been around, kicking around for about 4 years now, since 2022. So are you going for let's slow this down, or are you going for let's kill it completely?
let's get this right is what we're going for. And at the end of the day, polling would show that 73% of Americans do not support legitimizing the crypto as mainstream. So whose interests are we representing? Whose interests are we rushing ahead for? At the end of the day, let's take the time to get this right and ensure the appropriate safeguards and unintended consequences are dealt with.
Independent Community Bankers of America President and CEO Rebeca Romero Rainey joining us. You got to come back soon. We do appreciate your time, Rebeca. Thank you. Well, coming up, we're going to talk prediction markets with PolyMarket advisor Rebecca Rettig of Jito Labs. It's Bloomberg.
All right, it is midday right now, and we have stocks holding near their session highs. You look at the NASDAQ, it's now just barely changed as opposed to down more than 1% earlier. The S&P 500, Tim, is up a third of 1%. And the Dow Industrials, interestingly, leads the way among all the major indexes. It's up by 1.25% because of Sherwin-Williams on earnings. Okay,
what's going on at the Federal Reserve and what's happening at that meeting? We'll find out tomorrow, just a little after 2 o'clock.
How long do you think the news conference is going to last?
Oh, is this a PolyMarket /
No, it's not.
question?
It's a genuine question. Yeah, because, I mean, he's made clear, Kevin Warsh.
It depends on what how long the task force said to go.
The task force is still going to go on until the end of the year.
Okay.
So he's going to say there's a task force for that. When it
All right. I think about 45 minutes. That's my prediction. Okay.
It's a lot shorter than usual.
A lot shorter than usual. Hey, coming up, if the Clarity Act fails, how does that impact the U.S. standing in the global digital asset ecosystem? D. Sharawat from Bloomberg Intelligence stops by. He is in town. He's going to explain next. This is Bloomberg Crypto.
Welcome back to Bloomberg Crypto. I'm Scarlett Fu alongside Tim Stanovic. We just had Coinbase and the Independent Community Bankers of America give very different positions on Clarity. One arguing that it's essential for U.S. competitiveness, the other raising serious concerns about deposit erosion and consumer protection. So let's bring in our Bloomberg Intelligence senior analyst, D. Sharawat, to kind of play referee and give us his take on all this. You are a market structure analyst who has to advise institutional clients on both sides of this debate. Where does each side's argument ring true for you? And how does that position this bill if it actually passes this fall?
Yeah, sure. Clarity seems to be the never-ending story of 2026, actually last 2 years. So I think, look, both parties are correct, right? Correct, and they're driven by commercial interests. And I think separating out what the philosophical arguments are with commercial interests is a tough thing for regulators to do. So let me take each side. If you look at Coinbase, clearly, I mean, Brian Armstrong has been asking for clarity around crypto regulation since 2018, way before we were talking about stablecoins or any of this debate, right? So he's been on this, I'd say sometimes tirade that Congress needs to be more clear what the CFTC, SEC regulations are. Having said that, recently, the push that he's had and Circle has had, the crypto lobby has had, around making sure that there's a level playing field and there's going to be yield that should be allowed for stablecoin deposits. That is obviously mixed in with commercial interest that Coinbase has. They do make $1.35 billion every year through the Circle partnership. So you can say that there is an argument there that's kind of mixed in with commercial interest and a philosophical argument. But I think, in fairness, what he's arguing for is outside of the stablecoin yield issue, clarity around SEC CFTC's jurisdiction. That is incredibly important.
I'm going to put you on the spot a little bit because you talked about the philosophical side of this, the commercial side of this, but what about the consumer protection side of this? And I'm just curious, as somebody who has been looking at this for years, you understand the arguments from both of these sides. What does it at the end of the day mean for the person who's actually putting their money in these accounts?
Yeah, I mean, look, the argument from the banks is that, look, the stablecoins are going to siphon every deposits from, particularly community banks. If you look at the biggest threats on community banks, it's not coming from crypto. It's coming from the fintech. It's coming from the chimes and the cash apps.
So the high yield savings accounts that make it really easy.
Have been draining the deposits of consumer accounts for a long time. Well, crypto is also obviously, potentially could threaten community bank deposits. but much of the threat is coming overall from digital banking. To some extent, and this is where I'd hold the consumer bank lobby, to task is, or question them, is that they are focusing on crypto, but there's a whole lot of other threats that's happening. It's basically about digital banking that's making an issue. To answer your question around consumer banking, absolutely one of the critical issues they're arguing for is that the crypto industry is operating under a weaker regulatory jurisdiction than traditional banking, including consumer banking. So they're beginning to offer, the stablecoin industry, Coinbase is offering products that are lightly regulated and not operating on the same guardrails, same protection, same regulatory oversight as traditional banking is. On that point, the commercial guys are completely fair. So I think, as I said, you can argue, both sides have right arguments.
All right, I want to move on to something else that you pointed out, which I think is really interesting. On July 21st, S&P Dow Jones Indices launched an S&P Pantera Digital Asset Index. It's an 18-constituent rules-based crypto benchmark, and it screens tokens based on protocol revenue rather than price momentum. The one thing it doesn't have in there is Bitcoin, which seems really odd. I mean, that is the OG digital coin. So how is this a benchmark for crypto if it doesn't have Bitcoin?
Yeah, great question. Let me just take a step back and describe, what's actually happened. So S&P is basically come up with a benchmark for all crypto assets. It's an institutional grade benchmark. So this is the first major benchmark for institutions to actually say, if you want to put $10 million, $100 million, how do we sort of divide that? What's the benchmark against which we should invest? So first of all, let me credit them for coming up with the benchmark with Pantera Capital, which has been in the business for the last 10 years. There's very clear parallels to the S&P 500 when it got constructed back in 1957. Now, it's been 70 years, it's been a long time, but there are some parallels in the sense that this is the first industrial institutional grade benchmark that Pantera is going to manage. There's about 16 tokens they're going to invest in. Bitcoin is not one of them. And let me explain why. If you look at how Bitcoin has been performing last 2 years, it's a different, almost different asset class. It's more akin to gold compared to the other tokens, which have got more equity-like characteristics. Ethereum, whether it's a Tron chain, Binance Coin, Cardano, these are all platforms. Yes, they are tokens, but they are development platforms in which other commercial businesses are built. So you can evaluate them as an investment opportunity for the investment that they support. Bitcoin is very different. So yes, it seems quite odd. The Bitcoin is not part of it, but I think that's actually quite deliberate, recognizing what's actually happening with Bitcoin anyway, that's operating very differently than other tokens.
Dee, we only have like 30 seconds left, but does it create some sort of bifurcation when you think of like Bitcoin as one asset class and then sort of the yield generating stuff as another?
It absolutely creates a bifurcation, Tim, but I guess, like I said, it's not that S&P is recognizing what's been happening anyway. Institutions are allocating very differently when it comes to Bitcoin versus all other tokens.
All right. Dee Sharwat, he's usually in Boston. He came down to New York City to hang out with us here.
Make us smarter.
In our Bloomberg studios. And good news, if you want more of Dee, he's joining us on Bloomberg Business Week Daily in the 4 o'clock hour. So be sure to tune in for that. Coming up next, the sports apparel company Fanatics making an acquisition to push into prediction markets. Plus, we're going to speak with Rebecca Rettig, COO and Chief Legal Officer at Jito Labs. Maybe we'll talk some prediction markets with her too. This is Bloomberg. Well, let's get to the odds. Our look at the latest news in the booming prediction markets industry. The sports apparel company Fanatics has struck a deal to buy sports prediction markets broker and dealers Water Street Labs and CX Clearinghouse. These properties are federally regulated and could give Fanatics a foothold in the event contract space. Bloomberg's Catherine Doherty has been covering this story. She joins us now. Cat Fanatics, I think a lot of people are familiar with it for, you can buy jerseys there, as you write about in your recent pieces for Bloomberg News. How big is the prediction market in sports? I don't want to say gambling or betting. Prediction markets when it comes to sports industry for Fanatics. Like, how big of a move is that?
So, Tim, you're absolutely right. When people think of Fanatics, they think of their massive sports audience. They think of the jerseys. They think of the bobbleheads that you can buy online. But they've also expanded into more of a direct-to-consumer engagement, whether it's sports gambling. They have their own sports book, and they also offer prediction markets. That's most recently previous to yesterday and this announcement that we'll get into with Crypto.com. And now they're going to be operating their own prediction markets exchange, which allows them to list contracts. It could be starting with sports, but expanding beyond that, it could relate to economics and other yes or no binary events that they can offer, again, the consumer client. And that's really been their whole goal, is to expand beyond just being known for the consumer products. It's the engagement and bringing the fan base closer to them.
Okay, so that's from the Fanatics point of view. BGC now gets a toehold in a new asset class. What are you hearing from them, and what are their ambitions?
That's right. So BGC is used to operating, whether it's trading venues or directly connecting with their institutional client base. For them, this deal brings prediction markets closer to their clients. They want to keep more of their core client base trading with them. This is another asset class that they can add on to what they already offer outside of prediction markets. And again, if it's starting with sports, that's going to be a very niche use case for these institutional clients. There's a big question on which of the institutional clients are actually going to be engaging with sports contracts specifically. They see this as a long game that they can expand beyond sports into, again, markets related. Think whether or not the Fed is going to raise or lower interest rates. And that will bring in and combine what they see is not a world of institutional and retail separately, but they think in order for prediction markets to enter the next level, that those two client bases need to start engaging.
Fanatics and Fed prediction shaking hands, right?
Goes hand in hand.
It does,
of course.
totally.
Naturally.
Bloomberg's Catherine Doherty, thank you so much. Really, really appreciate the reporting on that. Let's continue this conversation with Rebeca Rettig. She is COO and Chief Legal Officer at Jito Labs. She's an advisor to PolyMarket as well. Rebecca, thanks for joining us. As you just heard from Catherine, Fanatics bought this CFTC-regulated exchange and clearinghouse from BGC. Robinhood, we know, is talking to Crypto.com about adding event contracts on top of what they already get from Kalshi and others. Clearly, prediction markets is no longer just the domain of PolyMarket and Kalshi. You've now got Fanatics, Robinhood, Crypto.com, DraftKings, FanDuel, Interactive Brokers, all building or buying prediction market infrastructure. Is the CFTC, the regulator, actually, in charge of prediction markets, equipped to supervise an industry that's gone from, 2 big players to something like 10?
I think it's even beyond 10. As you noted, there are a number of industry players and beyond who are getting into the prediction markets or event contract space. And the market to buy the regulated exchanges, what are called designated contracts markets, and the clearing organizations, so DCM, DCO, has been very hot for the last year to 18 months as well. The CFTC certainly has the capacity to do it, and they have been very public that they want to be the primary regulator here. We've seen them coming into court cases around the country to assert their jurisdiction over these markets. So they are continuing to build out their capabilities. They obviously have a number of longtime staffers there who have been working on, DCMs, DCOs in general. So they will probably need to staff up more. That's certainly been something that they have been focused on doing, but they really want this to be in their jurisdiction only.
Going to the question of competition, I'm not going to repeat every company that Scarlett just did that's getting in on this, but it literally feels like everybody is getting in on prediction markets in some way. I mean, we spoke to Rick Wurster over at Charles Schwab last week on Bloomberg Business Week Daily, and he's talked about how he sees prediction markets possibly becoming part of the Charles Schwab platform, and he draws a distinction between betting and gambling and sports versus what people can do, to be served financially. But I'm just wondering if the pie is actually big enough for all of these players.
I think we don't know exactly how the prediction market space is going to shake out long term. I think there is a lot to be gained here. And if you actually look back to where prediction markets started, they did start out as a hedging tool. We obviously think a lot about them because they've become so much part of the zeitgeist from a sports type of instrument. But we just saw Kalshi announce today that they are launching event contracts on flight cancellations. And we saw that somebody who's holding a big conference wants to take out one side of an event contract in order to be able to hedge potential losses if the conference can't go forward. That's traditionally how event contracts were used. It was something, and this is why it's under the CFTC's jurisdiction. It was something where farmers would, bet on whether there'd be a tornado in order to be able to get additional insurance on top of the insurance they had for their crops. So seeing how these actually become more mature parts of the financial system remains to be seen, but that definitely leaves a lot of space for different players to take on different spaces in the prediction markets industry.
Rebecca, the other thing, of course, is a federal judge blocked Minnesota's felony ban on prediction markets, saying that federal law likely preempts it. I'm wondering whether this Minnesota ruling basically kills every other state's ability to get near this.
We've seen courts come out different ways. The most interesting thing is that the court in the Southern District of New York came out the opposite way from the Minnesota judge. And so what I think we're really going to see from a long-term perspective is that this is going to have to go to the Supreme Court to at least put some contours around who has jurisdiction over what and for how long and in what ways and what types of markets. Because when courts around the country come out different ways, that especially on whether state or federal law preempts or is the primary mode of regulation, then it has to go to the Supreme Court for a final say.
That's a very long way away at this point, but given the experience you have as a lawyer in legal when it comes to fintech, what could the contours of that be from the Supreme Court? Again, it's conjecture at this point, but what's a realistic way to think about this?
Sure. And Sandra, I know it does seem far away, but I would bet we see it go to the Supreme Court in 2027. And in terms of what that looks like, the Commodity Exchange Act says certain types of markets may not be permitted, and one includes gaming. But we haven't really seen a definition of what gaming does and does not include. And we've actually seen the sports teams either working with or commenting to the CFTC on what prediction markets should and should not include. Just yesterday, the NFL submitted a letter to the CFTC in response to their prediction market rulemaking, and they said that there are certain contracts that are readily susceptible to manipulation or knowable in advance for things like first play of the game, coaching decisions, roster and personnel decisions, and the like. And so I think what we will see really as the focus of a Supreme Court decision is how to define gaming, because that will obviously impact what markets the CFTC has exclusive jurisdiction over and what remains the primary purview of the states for gambling.
This could change everything.
Yeah, but it's not going to happen immediately.
No, if you're, a sports gambling platform, right?
Yeah, absolutely. Or, if you're expanding beyond sports, as all of these prediction markets are saying.
Still, everything that happens on these is sports.
I know. Rebecca, thank you so much. Really appreciate it. Look forward to seeing you again soon. Rebecca Rettig over at Jito Labs. She is an advisor to PolyMarket. She also serves on the CFTC's Digital Asset Markets Subcommittee. Coming up next on Bloomberg Crypto, an investigation by Bloomberg found that Tether, the world's largest stablecoin issuer, went from opposing stablecoin regulation to supporting the Genius Act after Trump insiders, including Commerce Secretary Howard Lutnick, reportedly helped shape the legislative process to benefit the company. We've got more from the reporter behind that story next. This is Bloomberg.
As the Clarity Act possibly moves closer to approval in the U.S., we take a step back now and look at how the first U.S. crypto law came to be. President Trump signed the Genius Act a year ago this month. It provided the first set of federal rules for stablecoins. In a recent big take, Bloomberg reporting that in the months before and after the president took office, his advisors, Howard Lutnick and Bo Hines, worked behind the scenes to loosen those safeguards and shape the law in ways that benefited the world's dominant stablecoin issuer, Tether.
And Tim, 1 month later, Tether announced it was hiring Hines as an advisor, and then soon thereafter, he was promoted to CEO of Tether's new U.S. product called USAT. We talked to Hines and Paolo Ardoino about that move.
I felt like this was a fantastic opportunity to jump into the private sector and do exactly what the Genius Act intended to do, which was onshore the best developers in the space, onshore the brightest minds in crypto, and make the U.S. the crypto capital of the world.
DT will be compliant with the Genius Act under the Foreign Issuer Protocol. And there is a pathway in the Genius Act to make it happen, and that's what Tether is focusing on. But at the same time, we felt the need to create a domestic stablecoin in the United States that is focusing on the actual needs of the US market. It is a very efficient market.
Bloomberg's Anthony Cormier is part of the team, gave an inside account of the negotiations surrounding the Genius Law. He joins us now. Anthony, congratulations on this report. I encourage everybody to check it out on the Bloomberg terminal at Bloomberg.com. But before we get into the meat of it, just remind us very briefly about the Genius Act and what it did.
Sure, it's a sort of landmark rule for stablecoins. It was the first federal regulatory framework for a particular type of crypto called stablecoins, which, as you guys probably know, it's meant to maintain a stable value. But what this bill did, which is different than what past bills did, is it gave us sort of an escape hatch for foreign issuers. Companies could be regulated not in the US, but overseas. So if the Treasury Department, Treasury Secretary decides that there is a comparable regulatory regime outside of the US, a company can maintain their sort of headquarters there and be regulated there.
So specifically, how did Tether benefit from the provisions inside the Genius Act?
Sure, well, Tether's first of all, they're the biggest player in stablecoins, right? They own, I think, some 60% of the market. And so they have the most at stake here. And they're headquartered in El Salvador,
outside
which is
the US.
Outside the US, which has historically been considered a very crypto-friendly regime. And so what the consideration is could they remain in El Salvador and be regulated there rather than having to come into the US and be regulated here?
Okay, so that's the background here and the meat of the story. The story, though, says that Trump insiders shaped stablecoin legislation before and after the president returned to office in January 2025. How did that work?
Sure. First, it was Howard Lutnick before he became the Commerce Secretary. While he was chairman and chief executive of Cantor Fitzgerald, he was essentially Tether's banker. We found court documents that say that he, quote, managed to kill every bill that would have affected Tether. And then when Bo Hines, a White House aide, came into the White House, he worked behind the scenes and he called himself the self-described bully on the bill and issued sort of red lines that were important to the White House and important to Tether at the very end of this.
And we showed how Tether responded to the reporting, strongly rejecting any suggestion its engagement with policymakers regarding stablecoin legislation was improper. We also heard from Mr. Lutnick and Mr. Hines as well. Thank you so much for all of this. Anthony Cormier, Bloomberg News reporter. It is one of our, it's the fruit of many months of reporting. It is pretty incredible.
Yeah, I mean, a most read story on the Bloomberg terminal. It's a big take from last week. Again, encourage everybody to check it out. That we barely scratched the surface with Anthony. Worked with a couple other colleagues on that story, again, spending months. Check it out on the terminal and at Bloomberg.com.
That does it for Bloomberg Crypto this week. Be sure to join us again, same time, same place. This is Bloomberg.